Hey guys, Ken Boy with the Accounting Accidentally Substack channel. You can find more articles here. And this was Halloween candy and unrealized losses. So I grew up in suburban St. Louis, and every single household when I was a kid handed out Halloween candy, and my bag was full in 20 minutes. You go door to door, and it felt like stealing. I couldn't believe how easy it was to fill up your candy bag. Obviously, you didn't know what candy you got until the end of the night, and that relates to unrealized losses on assets, which I'll get to in a minute. We have a tradition in St. Louis for Halloween that kids are asked to tell a joke when they trick or treat. Not many other cities do that. It's pretty unusual. So the payoff was you get home, you dump the candy on the floor, and you see what you got. I always have been partial to Reese's. I hope that I have some left over after Halloween this year. But of course, you always had the health conscious family that handed out apples, just plain apples, which wasn't very fun. So the point is, there's no way to know what you're getting, which brings us to unrealized gains and losses. You need a buy and a sell to have a realized gain or a loss. So let's say you buy 100 shares of Apple common stock at $25 a share, and you sell 100 shares at 40. The per share gain is $15 a share, and your total realized gains are $15 times 100 or $1,500. If you sell 100 shares of Apple at $18 per share, you have a loss, a realized loss. 25 less 18 is 7 times 100 shares is a $700 realized loss. An unrealized loss means you have a buy but no sale yet. So if Apple stock went to 40 and you didn't sell, you'd have a $1,500 unrealized gain. Same thing with a loss. If the stock went down to 18, you held the Apple stock and didn't sell it, you'd have an unrealized loss of $700. And when a business owns investments, they must often disclose unrealized losses to financial statement readers. Disclosing unrealized gains and losses. So here's a quote from Reuters. Bank of America reported unrealized losses of $131 billion on securities in the third quarter, but the bank did not expect the portfolio would generate actual losses in the long term. Now, that number, 131 billion, looks pretty staggering, but you need to keep in mind that Bank of America has $3.1 trillion in assets. Plus, Bank of America categorizes the assets as held to maturity. These are bonds that have a fixed maturity date. They mature at the original face value. So if you buy a $1,000 bond, face value, hold it till maturity, $1,000 is repaid to you. So here's a quote from the CFO. All these are unrealized losses on government guaranteed securities. Because we're holding them to maturity, we anticipate that we'll have zero losses over time. So using the Halloween candy analogy, it sounds like Bank of America thinks it will get back all bond principal repaid, and financial readers will know what's in the bag because they'll get all their money back. So why is there a focus on unrealized gains and losses now? And there's two reasons. Silicon Valley Bank, which I'm going to call SVB, and higher interest rates. And you've probably heard about the SVB crisis, which happened over the summer. Unrealized losses have come under closer scrutiny by investors since March. It was actually in the spring. At the time, Silicon Valley Bank sold a portfolio of its holdings at a sharp loss, precipitating its collapse and fueling the worst industry turmoil since the 2008 financial crisis. So that's one thing. In addition, interest rates have increased sharply, meaning that all outstanding bonds are worth less. So why is that? Well, let's assume that Bank of America owns 2% 10-year Treasury bonds. As of this writing, current 10-year Treasury bonds are selling at 4.7% with rounding. So 2% Treasury prices have declined because investors can now get a higher coupon, 4.7%. So what's the bottom line? Sometimes a business has to sell bond investments that they intended to hold to maturity. In the case of SVB, they had to sell the bonds to repay depositors when billions of dollars were leaving the bank. And SVB incurred huge realized losses buy and sell. So the lesson, just because a business intends to hold bonds to maturity does not mean it will always work out that way. SVB had to hold a fire sale to put out a financial fire. So pay attention to unrealized losses so you know what's in your Halloween candy bag. Remember that you can find other content on business, accounting, and finance at Accounting Accidentally at Substack, and you can subscribe for free. Thanks.